All right, good evening, everybody. Uh, Penultimate session for the day, and just because we have a serious topic doesn't mean this has to be a serious session, right? We can still have fun while we're at it. Let me begin by, I guess, the serious question first. Let's just do the intros, maybe. Why don't we start with you, Michael? A quick 1-minute overview on yourself and your organization, please.
Yeah, no worries. Well, thank you for having us. And yeah, for those who I haven't met yet, I work at Savills Hotels based out of Singapore. I've been based there for the past 7 years, but have predominantly worked in the capital markets space in cross-border investments, but I've recently crossed over into the hotel sector. So, yeah.
All right, thanks. Ian, over to you.
Introduction?
Yes, please.
Okay, I'm Ian. I work for a group called SC Capital in Singapore. We're a private equity real estate shop, privately owned. We invest in hospitality and all sorts of other asset classes, including mechanical graveyards.
Interesting. All right, so
I'm not going to be working here for very long because I just, we had a word with Ritesh, and I think we're all going to be working for him in about 15 days, something like that. So.
yeah, and we should touch on that one sometime during this talk, and that is an interesting one. Yeah. Suwito, over to you.
Thank you. Thank you for having us. My name is Suwito. I'm founder and CEO of Republic Capital Management, mostly a family office, and also invest in hotels and other real estate development.
All right, brilliant. Thank you for the quick, brief introduction. So we have a family office fund. We have, would you call it institutional capital, the right way to put it?
You could.
You could, okay. And we have Savills, one of the best known names in the world in the transaction space.
By the way, thanks for telling me the dress code.
You're dressed appropriately, we're not.
It was smart casual, wasn't it?
All right, let's start with you, Suwito.
Sure.
The topic at hand is looking for deals in this market and in this cycle and looking for ROIs in the bargain, right? Let's begin by getting a perspective regarding this cycle. What cycle are we in? Generally for Southeast Asia and specifically in Indonesia.
I think it's a bit difficult to see which cycle in each market. I think generally we are quite bullish with Thailand and Philippines, a little bit less bullish with Indonesia, despite with all the promotion of what the government said about Indonesia growth and potential. We still facing some issues in terms of getting the ROI of the yield that we want. That also is because of cost of capital is quite high in Indonesia compared to other countries like even Philippines. So we are facing different type of a capital structure in Indonesia at the moment.
Let me interrupt for a second. What is your cost of capital for borrowing, say, in Indonesia, for those in the audience who may not be locals?
Indonesia is ranging from 10.5% to 12% in local currency. And it's really difficult to get US dollar financing for Indonesia unless you have other assets that you can leverage overseas and bring it back to Indonesia. But then you are facing with a potential currency risk. So you need to hedge it, so there's no point to also borrow foreign currency.
Okay, so just taking that forward over to you, Ian. Suwito says not so bullish. He didn't say I'm bearish. Not so bullish is a nicer way of saying that, I guess. But let's marry what he's saying in this cycle to what we've been hearing all day, which is there was an underpinning discussion around hope and around growth and around 10 new leisure destinations. So there is clearly a medium to long-term plan that is being put in place by public-private both sides with regards to Indonesia as an investment destination. Do you think this is a short-term problem that Suwito brings to fore?
The cost of capital, I'm not making any predictions about the cost of capital in Indonesia, but hopefully it goes down over time. I think, it's a fundamental problem, I agree. It's, you have cost of capital, cost of debt, that's like 10 to 11%, sometimes 12. And when we're talking to Savills about, buying things in Indonesia, then the cap rates are, I don't even want to mention it, but they're in the the single digits, mid to semi-high kind of single digits. It doesn't work. So you basically have a negative carry on your debt. You get no happiness from your debt. Normally, guys like us will lever up to get a higher return, and here you can't do it really because you count on everything then coming back in terms of your capital appreciation. So it's hard. There might be other ways of doing it. I mean, we kind of invest all over the it's kind of all over the spectrum in terms of risk and other measures. So it's a capital structure as well. So what we've done here is to buy debt on property that's performing, but so it's a different kind of investing. But I think there are things to do. Maybe you can provide debt to places as well, especially if it's US dollar denominated. If you've got a base rate that's like 10, 11% in rupiah, and you need a slug of mess on a project. We could be there at somewhere clearly north of that, but so it depends on the project. So that kind of things you can probably see here. But so generally speaking, I think tourism in Indonesia, I'm a huge fan. Have always been. Bali has always just been the beginning. There's many destinations here that are interesting at different levels. So I think over time this is clearly going to be a tourism center for Asia Pacific because it's so vast and so varied. The question for us is what time do we go into those kind of places, because it's a bit early. The markets are still very small. So when you have initiatives going on like airport building and so on, all of those markets, there's lots of positive thoughts around what's going to happen tourism-wise, and it will happen, but there's also a lot of people plowing money into hotels, and so competitively it could be quite a bit challenging at that point.
Brilliant, thanks. So, Michael, what I'm hearing so far is that demand may not be as much an issue. Yes, infrastructure is a challenge. We've heard about that all day today. The airport needs to expand. I think the recurring thought we've heard in the last two answers is really the cost of capital, and specifically debt and the cost of borrowing. And Ian alluded to the cap rates being in the lower to mid-single digits. And you marry those thoughts and you realize doing deals is obviously going to be tougher than one would have thought. How do you, as Savills, do you agree with that? Are you seeing movement? Are you seeing transactions? How do you address concerns of investors like Ian?
Yeah, okay. And I think looking at the broader market first in terms of transactions in Asia Pacific, generally the market's performing pretty well. I think last year, if you look at commercial transactions, hotels made up about 5% of all those transactions. And this year it's kind of forecast to be around 15%, which represents about $10 billion in value, and that's in APAC. But all that capital, to be honest, is heading to more mature markets like Australia and Japan. In terms of investment into Indonesia, the kind of clients that I deal with, the offshore investors and whatnot, they're only really looking at the two kind of key gateway markets of Jakarta and potentially Bali. They wouldn't really move further up the risk curve and do those 10 new Bali type locations. In terms of how I satisfy, Ian's kind of concerns, we're about to bring to market 2 assets in Bali, both large-scale, institutional size kind of assets around 100 million plus. And I can give you an indication in terms of yield, those will be trading for, just north of 8%, but it's still hard if you're borrowing locally to make that stack up. So I don't know if you've got to get creative with offshore debt and go about it that way, perhaps.
Okay, that's an idea.
Are they stable assets, or they've been trading for a while?
Existing, incoming, stabilized assets. Yeah.
Would that be attractive, just as a hypothetical, Ian?
Yeah, maybe.
All right.
I don't know what they are, so I have no idea what you have to do to them. But yeah, potentially.
All right, Suwito, I'm coming back to you. Let's talk a little bit about valuations and worth of hotel assets in Indonesia. Have you, by the way, and please feel free to share what you feel, what you think you're comfortable with, have you looked at acquiring assets? Do you own assets here? And what kind of trailing 12-month multiples would you be, for instance, looking to trade at?
Well, we do own assets here in Indonesia. I mean, like in terms of valuation, I think the asking price and the expected acquisition price is still very far off. I mean, everybody, of course, want to get their money plus a lot of returns, but from us, in terms of acquisition price, we also want our returns, and especially if we borrow to buy it or to acquire it, it's still not matching, right? Between the yield of 8% to 10% with the debt of between 10.5 to 12%, there's still a mismatch between the expected buyer price and our price. But having said that, there is a different type of products that maybe is a mixed-use asset where we can sell part of the office building or residential, then we can probably keep the hotel for almost, like, hopefully half of the acquisition price. That's one way to look at it. Or recently we see more and more people doing a condo hotel. Maybe some operators willing to loan their brand to create this type of products. Then there's probably another way that some of the buyers can achieve the return they want.
Yeah, but said another way, you're saying a typical traditional hotel under a typical traditional management contract is a tough sell. You need a mixed-use development, or you need a condo hotel. You need some kind of assurity of higher returns from that a traditional hotel, I guess, cannot offer when it comes to. Is that a fair assumption? Is that how you see it as well?
Just need a lower price.
Yeah, agreed. if only that could happen, right?
Yeah. I don't want to complicate things. I mean, you know, all of those things. I mean, it's like I think Indonesia is a great destination for condo hotel developers. I think I mean, you see them everywhere, and it's sort of like. I mean, maybe Eric will laugh at me a little bit, but you know, 10 years ago, it was like see so many guys who are out like promoting condo hotels, and at the end of the day, somebody's going to end up carrying that bag.
Yep.
And those promises of those returns are not going to be there. It's clear, and when you know the business a little bit, but the people that are buying them, they have no idea. But I think eventually they're going to be, So I think some of that stuff is probably happening right now. I'm sort of a little careful with that, to go into a condo hotel kind of development. But there are other ways of slicing it. I mean, you could do it, vanity real estate, which means this kind of resort real estate is kind of different price than other things. So
sure.
Potentially, but yeah.
And on the earlier question I asked Suwito, does SC Capital have ownership of assets in Indonesia presently? Hotel assets?
Yes.
And okay, we'll leave it at that.
Sorry, we kind of backdoored something a little bit, so it wasn't a normal kind of deal, but it was basically we bought some NPLs here and converted it to ownership of a resort, and we did a whole bunch of other things, but I'm hesitating to say yes because we're also in the process of perhaps letting that go.
Fair enough.
Yeah.
All right, Michael, back to you. I wanted to understand, when you look at deals in Indonesia, and any part of Indonesia for that matter, one of the recurring challenges I've read about and heard from clients is really diligence and the quality of due diligence that is required and is not always easily conducted. Is that a fair blame to make? I mean, is that one of the hindrances to getting deals done here?
I think when you were kind of referring to due diligence, I think a lot of investors, the offshore guys, stumble when it comes to the tenure of ownership. The various HGB and different title systems here. It's a bit hard for people who are used to freehold to get their head around a leasehold tenure, and a lot of these are also fragmented ownerships, right? So it's a single asset, but there's 4 different titles and 3 different owners, and you got to manage some sites which have different levels of leases remaining.
Okay.
Yeah, that's confusing as heck.
Yeah.
Well, yes. We have, I mean, on DD questions, it's kind of funny because we do DD on properties on the way in, I mean due diligence, and then the next guy also does due diligence on the way out. And we've actually, what we've done is did both ends on this one property here because we were actually planning to put it into a public vehicle. So we kind of did diligence on ourselves. And the answers or the findings that you get on the way in are completely different from the findings that you get on the way out. So
You use different lawyers, right?
what?
You use not the same lawyers, that's why.
No, exactly. It's different DD provider, right? So one guy, he said, oh yeah, you got a massive problem here with GFA, and it was like 25% or something like that, and it's up on the roof and in the basement. And the guy on the way out said, hey, you got a small problem, you know, I can fix it. And it's mostly it's in the garden or in the basement, that kind of thing. So it's kind of like, well, you don't know. I think you have to have a tolerance for uncertainty here in terms of your DD findings. If you're, you know, and that gets hard because when you're institutional capital like us, it's hard to, well, you have to put your neck on the line for it essentially, because if something goes wrong,
Yeah.
with with what our DD providers have found, we have to stand in front of our investors and say, well, yeah, it kind of screwed up over here, and we knew about it. That's not a good situation. So
Absolutely.
that becomes quite difficult.
All right, thanks. Suwito, just I think a more macro question is, since you understand, I'm assuming, the market well, if all the boxes were checked, diligence, valuation, what would be an interesting market? What market, according to you, offers more promise from an investment standpoint in Indonesia? Bali is a no-brainer, I would imagine, if the other boxes were checked. Any others?
I think it's still, I mean, as an investor, I think we're still focusing on key cities like Jakarta and Bali. I mean, the effort that you put in to do the due diligence and the travel times, even though all these infrastructure is being built, is still not worth the time spent. So we're still focusing mainly on the Jakarta and Bali.
And if I may take the second question to you as well, from a positioning standpoint, does your intel tell you that there's a certain positioning of hotels that are more lucrative? Traditionally, and again, I'm saying you speak about it in a neutral sense, irrespective of geography, it's often believed that both ends of the spectrum are the most interesting. Either you go budget economy because these are very cookie cutter and they're easily tradable, plus they're high margins because there's no F&B and so forth, or you go luxury where there's a element of premium that you could get at the right time of the cycle.
Yeah, if we look at the earlier presentation or discussion, I think everybody mentioning about the GOP and all this about for the mid-scale is about 40 to 48%. So I think it's still, if we go back to the yield and the cost of capital, I think at the end is still the mid to middle low. Is still the quickest in terms of asset type for your return on investment. Like Pak Amir mentioned this morning that it took 44 years for one of his projects to get paid back. So, and Pak Budi also mentioning that, you know, you have to have a mixed-use project in order to make it make sense. So if you stand alone, I still believe that the mid to middle low is the quickest to get investment back.
And I would imagine when it's institutional capital or private equity or money that has been invested with a very specific exit strategy possibly already in place, a 5 to 7 year horizon is probably a fair one, Ian, or do you think that's too generic a statement to make?
Yeah.
Okay.
I don't know. I mean, our money is 8-year money, and the way that you make returns in the opportunistic space is by doing it fast, generally speaking. So the whole periods are quite short. They're 3 to 4 years, maybe 5. We have some investments that are, you know, at the inception are written to 7 years,
Sure.
but that's unusual. It's quite unusual. So so I think in terms of that, you know, that kind of drives the type of property as well that we, you know, generally prefer, and it's more along the lines of of the previous comments. So it's easier to predict, it's smaller, quantums, it's, less variability in terms of outcomes of costs and quality and so on. So I think that's, it's easier to invest in that space, clearly. Yeah.
Okay, and just that question asked a different way for you, Michael. What does your intelligence and market knowledge tell you from a opportunity standpoint? Where are the opportunities? I mean, who are the sellers today? Are they budget space players or luxury or mid-scale? And are they in Jakarta, Bali, or do you have other markets as well?
Yeah, I mean, I guess every market's got its different dynamics. I think we're all aware that the luxury market in Jakarta is pretty saturated and whatnot. But I think when I'm helping clients out from the investment standpoint, they're not really looking at where the positioning of the asset is. They're just looking at the asset class and saying, we don't care if it's a luxury or budget hotel. Market yield for that kind of asset is at this level, so that's what we're willing to pay.
Just stepping away from just specifically Indonesia. Actually, I'm thinking about development here. So that was, my comments are basically around developing stuff.
Okay.
Yeah. Easier prediction around that. So in terms of standing assets that has a demonstrable cash flow, I think that's easier. It doesn't matter what grade it is. Then it could be, budget or economy or luxury. It doesn't really matter.
Suwito, you spoke about the cost of borrowing. How's the liquidity? How easy is it to borrow, assuming you were willing to pay 11%?
The liquidity is there. It's just the bank is just not the lending. I mean, like especially on the new hotel development, right? They've been very careful in this segment. It's not a liquidity problem. It's more like the confidence level for giving the lending to hotel development. If it's standalone hotel development, it's been a challenge for most of the developer. So currently, I think unless you have an existing hotel that you can leverage, then I think it's a bit more challenging to do a fundraising, so you have to do different other way.
And what's, either of you gentlemen may choose to answer this, what's most of the times been the debt to equity ratios that make for a healthy cash flow that can afford that debt in Indonesia? What's a fair assumption there?
For us, currently we have no debt, but for us, previously we doing about 50% from both combining the land and the development costs.
And Ian, what would you say?
Different answers. So the thing that we bought here was a debt, and that debt was 110% of the property's value, roughly. So that's different. I think if we are to buy something and lever it up here, we would, we generally are quite careful with leverage. So it would be like in the 50% range, 50, 55, maybe.
Sure.
Roughly about that. And maybe in the lower end of that spectrum, because the cost of that's quite high, and if you can only buy it at like 8, it's going to be difficult to service unless you're believing that there's growth in the NOI.
Okay. I am going to ask you a question that you've probably asked yourself all the time, as long as you've been in the investment business. It's a very generic question, but I get asked this as a consulting firm person all the time from hotel developers. I'll read it out. Certainty of returns is nearly not as likely as some other asset classes, right? You and I both know that hospitality, hotels are the business of selling rooms every day and doesn't offer the same certainty as office space or retail or residential for sure. Trading assets at a premium to DCF is tough. So when you're a buyer, they're asking you for replacement cost. When you're a seller, they don't want to pay you even the DCF value. So it's always tough to really trade at some stage across most maturing markets. Cost of capital, we spoke about. Return on capital is frequently lower than cost of capital. Why do people invest in hotels? Why do you guys invest in hotels basis everything I just said?
It's really fun.
No, honestly.
That's like 90% of the market, right? I mean, everybody who's building a hotel now in Indonesia, it's like basically it's because it's like, it's fun. It's like you building your living room to the world, right? That kind of thing. That's been going on forever.
I hope there's more to it than that, Suwito.
Well, somebody built it for lifestyle, right? I mean, like all ego, but but for us, it's like, well, we are building the lower end of the hotel market, so we are more looking for the fixed yield. So when you ask, so what you build and then how you exit, there's a few ways we exit. Either we go listing, or at currently in Indonesia, there's a new, we call a real estate investment trust, right? DIRE. So DIRE. So this is another way that Plaza Indonesia is working on it to put in the trust. So there's another way to exit or to do a fundraising.
Michael, would you also agree that while you may miss out on the guaranteed yet not so easily grown returns from the office or the retail sector, you also have the opportunity of serious multiples and serious exits in a really high cycle, and that probably compensates for the certainty of other asset classes? Is that a fair assumption?
Yeah, well, I mean, I think a lot of investors just diversifying, right? So got plenty of exposure in the commercial space and looking for something with a bit higher returns, and hotels can offer that, right? You can adjust the market very quickly. But yeah, I think people are just looking to diversify.
Okay. Yeah, you want to say something?
It's to be fair about hotel space. There's you have to pick your timing really well and your markets really well. And not that we've done that all the time. We have had some really shitty situations, but in the aggregate, it's been really good. And you don't have to. I mean, clearly, when you have a situation like you had in post GFC or Asian financial crisis, then theoretically you should be able to pick things up, for fractions of the dollar.
True.
And sometimes that happens, and I think increasingly so it happens because that mechanism to resolve problem loans and so on is getting better. It is not perfect, and it's nowhere near where it has to be or should be, but it's getting there. Mm-hmm. So at times like that, I mean, when we went into Japan in 2009, it was after GFC and it was after Fukushima. And, every tomato you ate, you thought you're going to have you're going to turn up green the next morning because it was radioactive, right? But, in times like that, I mean, you can buy things very cheaply. And in Japan, you could because there was just that mechanism is there for price adjustments, and people are taking them. The ownership is more institutional than it is private.
Sure.
And that kind of situation. Then you're buying it below replacement cost or below valuations, and it's easy. That game is easier. You just have to have a belief about the future, that there is one. It was a little hard with the nuclear thing going on, but but in other cases, I think like in places like Singapore, at the moment where you are buying, things at, or in Tokyo as well now, or all over Japan now, you're buying things at well above replacement cost. We were just, with our REIT in Japan, we just bid on an asset that's $950 million, something like that, just one single hotel. That one we didn't get, but we had a bid in on it, and it was, somebody else is picking it up now, and that was originally developed for 500, something like that. So you're seeing, I mean, all of those things, it's the same dynamic as in Singapore. What you're paying for at the moment is land cost. The actual hotel building is nothing, it's maybe 20-30% of the cost.
Sure.
And that, can go down when the sort of cycle turns. So it's a different kind of investing. You don't always have to buy below replacement cost, to make money. I guess is my point.
Agreed. Thank you for that. Gautam, can you show us some audience questions? We have 7 minutes left. I want to make sure we include some of these as well. All right, let me see. Michael, if Ian and Suwito asked you to identify a hotel acquisition opportunity, no cap on investment amount, what market and type of properties would you target? That's on you, Michael. What do you want to?
I think, a market that I've liked recently has been New Zealand, and that's only because I've worked that market for kind of the past 2 years for a Singapore-listed modular construction group. And for us, you know, that's an interesting market because not only is the hotel sector performing extremely well there, but there's not been much development at all because the local construction costs extremely high. There's a bit of a monopoly there on the building market, and as a result, there's a lot of pent-up demand. And so, with the modular construction solution, we're able to come into that market and build, you know, let's say local rates for a 4-star hotel were $5,000 a square meter. We were constructing at 3,000. So there was a fair bit of buffer in there and able to develop assets. Yields are strong, and it's a very transparent and easy market to work in. There's no stamp duty on real estate transactions. There's no capital gains tax. Granted, it's not as liquid as many other markets. A very small market, but yeah, I would probably put my money there.
Does that pique your interest, Ian? Are you interested?
Sorry?
Are you interested in buying what he's selling?
Sure. No, we looked at New Zealand before.
Yeah.
We didn't get to buy it, unfortunately, but it's interesting.
Yeah, there's limited opportunities though in that market in terms of existing assets.
It's so bloody far away. So
That too, yeah.
yeah, but yeah, it's good.
Okay, I think they're going to bring this back up, and let me ask another question or two before the audience questions comes back. Suwito, really just a broad view on what's on the horizon. We've talked about the challenges, and it seems we've talked more about challenges than opportunities today. Are there opportunities?
Well,
how's it looking going forward?
I think every challenges will come up with some opportunities, right? I mean, at the end, like what Ian just said, I think we will start looking at those distressed assets, that NPLs that banks might have or offered. We can continue to look at that. If there's a good opportunity or at a huge discount, then it could probably help us with the yield, especially if the bank willing to restructure and offer us a new loan. We might be able to take a look at that.
That's an opportunistic opportunity, if that's a word. But that being said, Ian and Michael, do you believe, is there good reason to believe that there is some, an upside or an upcycle or anything of consequence that would encourage people to want to invest and build more? I think what you established earlier on today was that there is an inherent demand that will continue to grow for hospitality, and there I think we're all on the same page. There is need for infrastructure improvement. I think the government recognizes that and spoke about that even today. Shouldn't that be reason enough from an investment standpoint that valuations would therefore follow, or an appreciation in valuation?
Sorry, I'm missing your question.
So what I'm trying to get to is that, yes, there is always opportunity, like Suwito said, to acquire assets when they're below replacement cost, like you said earlier, or if there is a distress. But is there inherent strength in the market that will allow for fair trade transactions at an acceptable cap, or do you think that it's overpriced?
Indonesia or?
Indonesia.
I have actually, we haven't looked at a whole lot, but the things that we've seen, there's a little bit of concern with some overbuilding, and some hotel markets are slowing a little bit. So I think if the next cycle, has to mean in terms of an upswing, that we don't have things going on like I think Hong Kong is actually quite a big issue, and Trump and Xi Jinping going at each other. So I think sort of global geopolitics are something that me personally are keeping an eye on at the moment, because it could, if there's like too many of these things happening at the same time, it feels like it's a little bit weak in the market, and that might trigger more of a downturn than an upturn.
Sure. So
having said that, so I think generally speaking, the markets are not, clearly markets are different at every point in time. They look at them, But on the whole, in Asia Pacific, I think our feeling is that it's a little bit overpriced in many places. And there's still some opportunity, there's still growth. I think like Indonesia and some specific areas is showing very good growth. Vietnam is showing really good growth. Japan keeps on growing, although slightly less than before. So places like that. But generally speaking, it feels like it's a little bit of headwind coming.
Sure. Almost out of time. Really quick, I saw a question here. What impact would relocating the capital have on hotel investments in Jakarta? Suwito, you want to take that?
I think Jakarta will continue to remain as a financial center, just like in the States, like New York and then Washington. So of course there will be opportunity in Balikpapan and Samarinda, but I think Jakarta will still be the main business center for Indonesia.
It'll continue to stay the commercial capital at least,
yeah.
you say.
So I think it will be like Sydney and Canberra or New York and Washington DC. So there will be still a lot of opportunity for hotel investment in Jakarta.
I would imagine the next question, have you guys ever made a bad or failed investment? The simple answer is yes. And do you want to elaborate? Everybody's ever made one, right? Have you ever made a bad investment?
No. They were all great when we started.
All right, fair enough.
Yeah, although we have, of course we have. I mean, we have, I don't know how many hotels we've done now, but it's probably, it's like maybe 700-800 million of equity into hotels. So do we have a couple of problems in there? Yeah, sure. I mean, one of them is a property we invested in a resource town in Australia, and it just did not go well. I mean, it's still going on, but it was right at the wrong point in time. We thought it was great because it had a very strong yield, even for Australia at that point in time. So it smelled pretty good, but it just didn't go well at all.
Well, that's rather ironic.
It's gas related, and then then you got to underwrite the dynamics between oil and gas, and when is the price point for oil where gas becomes better to explore, and it's kind of like I think we kind of stuck our head in the oven on that one a little bit.
I was going to say it's rather ironic. The place is called Resource Town, but on that note, I said just a joke. On that note, gentlemen. Thank you. I think we've run out of time. This was interesting. Hopefully, all of you got something from this. Thank you.
Thank you. Sure.